Welcome back to Factful Finance, where we dive deep into the world of financial insights that matter most. Today, we're tackling a powerful topic that can shape your investments and your wealth-building strategy in ways you might not even realize: how psychology affects market prices. Did you know that emotions, not just data, are a major driver of stock prices? We tend to think of the stock market as a place of cold, hard logic, but the truth is, human behavior is often the real force behind market movements. And trust me, understanding this can completely transform the way you approach your own financial strategy. Let's take a moment to think about this. Have you ever bought a stock because everyone was talking about it, or sold one in a panic when the market started to drop? If so, you've experienced behavioral finance in action, and you're not alone. Behavioral finance is all about understanding how psychological factors, like bias, emotions, and social influences, can drive investors' decisions. These decisions, in turn, affect the market prices in ways that traditional economic models just can't explain. Now, you might be wondering, what does this actually mean for me? Well, understanding these psychological influences is a game changer. Investors like you can make more informed, rational decisions when you recognize how your emotions and mental shortcuts can lead you astray. Behavioral finance allows you to stay ahead of the curve, because when you get a better grip on your own mindset, you can use these insights to your advantage. Let's break this down. One of the most powerful examples of how psychology affects the market is something called herding behavior. This is when people make investment choices based on what others are doing, rather than on sound financial analysis. Think about how stocks can surge in price because everyone suddenly jumps on the bandwagon. The classic example? The dot-com bubble of the late 1990s. Investors flooded into tech stocks, not necessarily because the companies were profitable, but because everyone else was doing it. The result? A bubble that ultimately burst, leaving many investors high and dry. Then there's loss aversion, a phenomenon where people feel the pain of losses much more acutely than the pleasure of gains. This leads to irrational decisions, like holding on to losing stocks for too long or selling off winners too early. Investors often want to avoid the psychological discomfort of realizing a loss, so they make decisions that ultimately hurt their portfolio. But by recognizing this bias, you can learn to make decisions based on long-term strategy instead of fleeting emotions. Let's bring this to life with a real-world example. Meet Sophia, a novice investor who's just entered the market. She buys a stock that's skyrocketing just because it's the hot pick everyone's talking about. But when the price dips slightly, she sells it off in panic, fearing further losses. As soon as she sells, the stock rebounds. Sophia's emotions got the best of her, and she missed out on a great opportunity because she didn't understand the psychology behind her actions. But there's hope, and here's the key takeaway. By studying behavioral finance, you can start to recognize these emotional triggers and make more calculated decisions. You can be like David, a more seasoned investor who, when faced with a market downturn, doesn't panic and sell. Instead, he sticks to his strategy, understands the biases at play, and uses volatility as a buying opportunity. So, how do you avoid falling into these psychological traps? It starts with awareness. Know your biases. From overconfidence to the anchoring effect, where we latch on to a specific piece of information and let it influence all our decisions. Once you recognize these patterns, you can start to control them. And it doesn't stop there. Developing a clear investment strategy with predefined goals and rules will keep you grounded. In moments of market chaos, your strategy becomes your anchor, guiding you to make rational decisions based on data and long-term goals, not emotions. But that's not all. There's a lot more you can do to protect yourself from these psychological pitfalls. If you've ever felt overwhelmed or unsure about your investments, talk to a financial advisor who understands how psychology influences markets. They can help you craft an investment plan that aligns with your goals, while keeping your emotions in check. Before we wrap up, here's a quick disclaimer. This content is for educational purposes only. Mentions of any products or services are not endorsements. Always consult with a certified financial professional for personalized advice. Now let's hear from you. What's the most common psychological trap you've fallen into when making investment decisions? Drop a comment below, and I'll make sure to respond to as many as I can. If you found this insight helpful, be sure to subscribe and hit that notification bell so you don't miss out on more tips to level up your financial game. Remember, understanding the psychology behind market prices is one of the most powerful tools you can have as an investor. It'll help you stay calm, collected, and ultimately more successful. And don't forget to check out the next video. We've got a deep dive coming up that'll change the way you think about managing risk in your portfolio. If you found this helpful, you'll love what's coming next.